If you leave your money sitting in cash, its purchasing power quietly disappears. The goods you could afford yesterday slowly slip out of reach as the currency itself loses value. But that lost value doesn't actually vanish. When living costs rise, the extra money you pay at the grocery store or gas pump goes to the entities that own the assets producing those goods. The wealth is simply transferred from people holding cash to people holding hard assets. We've seen exactly how severe this can get. During the inflation shocks of the 1970s, global supply constraints triggered massive price spikes across consumer goods, completely draining the savings of anyone exposed to the raw currency. You don't have to be a victim of this math. By structuring your investments strategically, you can build a portfolio that absorbs price increases and uses them to protect your wealth. Surviving periods of high inflation requires taking your capital out of vulnerable, unbacked cash systems and placing it directly into assets with mathematically secure, built-in defenses. The first layer of defense starts with a specific type of government bond known as Treasury inflation-protected securities, or TIPS. A traditional bond pays a fixed amount, meaning its real value drops when prices rise. TIPS work differently. Their underlying principle is directly tied to the Consumer Price Index, a government metric that tracks the average change in prices paid by consumers for a basket of goods. This chart shows how that protection functions. As the inflation rate climbs, the Treasury automatically adjusts the base value of your bond higher. And because these bonds pay a fixed interest rate, your actual payments increase alongside it. By locking in that baseline, you guarantee a portion of your wealth will automatically grow at the exact pace of inflation, neutralizing the risk to your base capital. You can also use debt itself as a defensive tool, specifically by taking on long-term fixed-rate mortgages to buy property. For generations, buyers have used these loans to freeze their housing costs in place. While rent climbs year after year, a fixed mortgage locks your monthly payment for decades. This creates a unique financial dynamic called the borrower's advantage. You borrow money today, but you pay it back over 30 years using future dollars that carry less purchasing power as inflation continues. This graph illustrates how that gap widens over time. While your debt obligation remains perfectly flat, average nominal wages and the value of the property itself tend to rise. Your fixed payment takes up a smaller percentage of your income over time. In this structure, you are actively using a depreciating currency to erase the real cost of your own loan. Beyond debt, holding physical assets provides another layer of active defense. This involves cash-flowing real estate and raw commodities. Commodities, like energy, agricultural products, and metals, are inherently tied to rising prices because they are the actual physical goods measured inside the inflation index. Because the global economy requires these raw materials to function daily, massive global trading volume forces their prices to adjust upward immediately in response to broader economic changes. Certain types of real estate operate the same way. Properties with high tenant turnover, like hotels or short-term apartment rentals, can adjust their leasing rates on a daily or monthly basis to match the rising cost of living. By holding the physical spaces and materials that society relies on, your investments naturally reset to higher prices exactly when the currency loses its value. Sometimes the financial system faces extreme stress, like sovereign debt crises or runaway inflation. For those environments, a portfolio requires assets with absolute scarcity. Gold has hundreds of years of data showing its ability to preserve wealth when fiat currencies collapse or when economic growth stalls while prices surge. Its value during these periods comes entirely from the fact it is incredibly difficult to mine. It is a physical asset that no single government controls, meaning it cannot be printed into existence to cover debts. Recently, computer science solved the problem of creating scarcity in the digital realm with the invention of Bitcoin, a peer-to-peer electronic cash system. Bitcoin defends against inflation through pure mathematics. Its underlying code restricts the total supply so that there will only ever be 21 million coins. Because the network is distributed across thousands of independent computers globally, no central bank or corporation has the authority to increase that limit or dilute the supply. Together, physical gold and finite digital assets offer a highly liquid, non-sovereign vault to store your wealth if traditional banking structures falter. The pieces now fit together: the mathematical adjustments of TIPS, the debt-eroding power of fixed mortgages, the immediate price response of commodities, and the hard scarcity of gold and Bitcoin. When combined, they form a cohesive structure that remains secure regardless of the economic turbulence happening outside its walls. Predicting exactly when inflation will strike or how severe it will be is a nearly impossible task for even the best economists. By holding a mix of these different asset classes, you eliminate the need to guess. The portfolio is pre-built to react and adapt to high inflation, slow growth, or system shocks automatically. Unchecked money printing will always pose a threat to those relying purely on cash. But when you construct a portfolio designed to absorb those exact forces, inflation stops being a crisis and simply becomes the mechanism that drives your long-term financial independence.